Hi everyone, welcome back to Introduction to Accounting. Sorry for the delay in the third video. I just got really busy with life, with work. I did some traveling, but we're back at it. So again, my introduction, I am a former instructor. I have a Bachelor of Business Administration with a concentration in accounting. I previously articled with a Big Four accounting firm and obtained my CPA CA designation, and I have various experience with public and private companies in the mining, energy, retail, and private service sectors. So again, like explained, I'm a former college instructor, and my goal is to put all of my teaching material on YouTube to help you with your studies, or if you're not a student, to help you learn about accounting. So today we're going to talk about adjusting journal entries for a period end. Our learning objectives are to talk about what exactly are adjusting journal entries, and then we'll go into two specific types, prepayments and accruals. So timing in accounting is very critical because business results are divided into specific time periods, such as a month or a year, and we report results for that specific time period. So we use the term fiscal year to represent accounting period of 1 year, and then interim periods are those accounting periods less than a year. So if a company is following a calendar year end, December 31st would be their year end date for their financial statements. And then that would be the date of their annual report. And you can see the rest of the year is broken up into quarters. So quarter one goes from January to March. The second quarter will go from April to June. Quarter three goes from July to September. And then quarter four is from October to December. And then quarterly interim statements will be prepared for each quarter. So recording transactions. So two questions come up when we record transactions. Which time period should we record the transaction in? And then what happens if a transaction affects more than one time period? So that's where accrual accounting comes into play. Now, the principle of accrual accounting is we want to record transactions when they occur, not just when the cash is received or paid. So, examples of transactions where that might happen is a sale where cash is going to be received in the future, or an expense where the cash is to be paid in the future. So, you can see a transaction still happens, but the cash is happening at a later time. Now, adjusting journal entries need to be recorded for the specific time period that we're going to present financial statements on. Look at two main adjusting journal entries. So the main one is accruals, which includes accrued expenses and revenues, and prepayments, generally prepaid expenses. Now, what is a prepaid expense? So it's an expense paid for in cash before it's actually incurred, and it's recorded as an asset on the balance sheet. Now, this asset is consumed under two conditions, either over the passage of time, such as prepaid rent, or through actual use. So, what it means is you consume the asset either as time goes by or you actually physically use it like a supply. The journal entries are pretty simple. So, when you first purchase the prepaid expense, you will record a debit to the prepaid expense account, and this is an asset. So, once you record the debit entry to this account, you also will have a credit to cash. And as you consume the asset, you'll see that there will be a credit entry to the prepaid expense account. And then we will also recognize the actual expense itself by recording a debit to that account. We'll do the example of prepaid insurance. So it's a very common prepaid expense. It's generally purchased in advance and used over the year. So you can think of car insurance if you pay for it in advance for the year. When you first purchase it, your journal entry will look like debit prepaid insurance. So let's say the car insurance cost 1800, and then you'll credit cash or accounts payable for the same amount of 1800. Now, your adjusting journal entry in this case, we're just doing it for 1 month, is going to be how much you would have used up for the month. So 1800 divided by 12 months is 150. So after the first month of purchase, we want to record an adjusting journal entry that will recognize how much of this prepaid insurance we consumed over the month. So then we would recognize a debit to insurance expense of 150 and then credit the asset. So credit the prepaid insurance of 150 to reflect that we've used up 1 month's worth of insurance. Now, supplies are different because they're going to be based on actual usage and not time. So, let's say you purchase a bunch of supplies for your office. You purchase post it notes, you purchase pens. So, when you first purchase all these supplies for your office, you're going to record a journal by debiting supplies for the amount that you purchased. So, let's say $1,000. Let's say we bought a lot of really good quality supplies and then you want to credit cash or accounts payable for the same amount. And then at the end of the month, let's say, you want to actually figure out how much you used. So you might go in and you might count all your supplies and figure out, hey, I had $1,000 worth and now I only have $890 worth of supplies. So that infers or implies that I used up the balance of 110 over the month. And then you're going to want to record that journal by debiting supplies expense for 110 and then crediting supplies, the asset account, by the same amount, 110. And so you can see this 110 is representing how much we actually used in the month. Now, another type of asset that I want to introduce to you that is also used over a time period is property, plant, and equipment. Now, some assets have a life greater than 1 year. So that would include land, buildings, and equipment. So these are known as long-term assets, also known as property, plant, and equipment. And the useful life, because it's longer than 1 year, is going to be the time period that the company can use the asset for. And then that can range. It can be anywhere from 2 years to 10 years up to 15 years. So the useful life will vary depending on the asset that the company has. The journal entry on the purchase of property, plant, and equipment is pretty straightforward. Okay, so when you purchase an asset, so let's say we bought equipment for 15,000, you just want to debit equipment for 15,000 and then credit cash or accounts payable for the same amount. So generally, we will record this at cost. Now, I'm not going to go into this topic into too much depth because it will be covered in a later video, but there are some other costs that will be included in the initial purchase. But again, we'll discuss that at a later time. This is just very high level to introduce to you how we record the original cost and then recognize that cost over its useful life. Okay, so we want to record the asset at cost, and we also then need to recognize that cost of set over its useful life. And that's where we introduce this term called depreciation. Now, that is the process of actually allocating the cost over the asset's useful life. So the equipment, we bought it for 15,000. It has a useful life of 12 years. Now, one way we can depreciate it, so we want to allocate that cost over the 12 years, is to do something called straight line depreciation. That is when we divide the cost evenly over the asset's useful life. So it assumes we use the asset evenly over 12 years. So 15,000 over 12 years is 1,250 per year. That would be our depreciation expense per year. Again, there are different other methods we can use for depreciation. This is very high level for today's purpose, and we will discuss the different methods in a later video. So going back to that depreciation expense of 1,250 when we record it at the end of the year, we're going to want to debit depreciation expense account for that amount. And then we're going to credit this new account called accumulated depreciation slash equipment for $1,250. You can see that we're not crediting the original account, so the actual equipment account. we're going to record it into its own account because we want to keep the original cost separate from the depreciation. So accumulated depreciation is actually a contra account. So what contra means is normally we have the equipment account, which is in a debit balance. This account will be in a credit balance, okay, and is connected to the equipment account. So therefore, it will reduce the net balance of the asset. You'll have the equipment account in a debit balance. You will have accumulated depreciation in a credit balance. And then the net balance will be the offset against each other. And the reason, like I was explaining, why we want to keep it separate is we want to track the total sum of depreciation expense since the purchase of the asset, and we want to track that separately from the cost. It's just to keep the records separate. Okay, so now we're going to go into accruals. So accruals happen where in situations where cash is exchanged after the accounting period. So what happens is the transaction occurs during the accounting period, but the actual cash will happen after the period has ended. So this is when we need to accrue revenues and accrue some expenses. So we're going to record them and there has been no movement of cash yet. So let's look at accrued revenues first. So this is what happens when the revenue itself has been earned, but cash hasn't been received yet. So let's say I'm an accountant, I performed some accounting services for a client, all the work is done, I billed them, okay, but I just haven't gotten the cash yet for the work that has been completed. So at the end of the year, I want to record a journal entry to recognize the revenue. So what we're going to do is recognize a receivable to recognize that the client owes money. So generally this might, like if it's related to a client, it would go under accounts receivable. But in this case, we're just keeping it general. So debit receivable, and then we can get into the specifics depending on the type of receivable it is. And then we'll credit revenue to recognize the revenue earned. And then the cash will be received after the accounting period. And then when it's received, we recognize the cash by debiting cash and then crediting our receivable and reducing that receivable by the amount that has been received. Accrued expenses is another topic we're going to discuss. So it's also known as accrued liabilities. Now, this is when the expense has been incurred but hasn't actually been paid in cash at the end of the accounting period. So we need to record it. So an example of an accrued expense is interest expense. So interest expense accrues, okay, so grows on a loan, and we need to record it at the end of the accounting period, even though we haven't technically paid that interest expense in cash yet. Now, a general formula to calculate interest is having the principal balance of the loan multiplied by the interest rate and then multiplied by days accrued. That would actually give us our interest expense. And we'll explain it by using an example. So let's say on April 1st, a company signs a loan. Okay, the loan amount is 20,000 and the loan is for 5 years. The annual interest rate is 10%. At December 31st, at the end of the year, we want to record the interest expense on this loan. So if we go back to our formula, okay, principal balance times interest rate times days accrued, that when you multiply will give us our interest. Now, for simplicity, instead of actually using the number of days, we're just going to round up and use number of months. Now, note that in real life, like the actual bank will use number of days. For our purpose, we're just going to, for simplicity, we'll just use the number of months. So we're going to use the principal balance of 20,000, okay, times that by the interest rate of 10%. And then multiply it for the duration. So 9 months, okay, from April to December. So 9 over 12. And that gives us an interest amount or interest expense amount of 1,500. Okay, and then our adjusting journal entry will be a debit to interest expense of 1,500 and credit interest payable of 1,500. and then just have a explanation that says we're recognizing interest on the bank loan as at December 31st, 2025. Now, this is one example of an accrual, where an accrued expense can include any type of expense that has been incurred but hasn't been paid for at the end of the accounting period. So we went over interest expense, but we could also have, say, we owe someone money for a service that they did for us. So, like, they did some repairs for us, but they haven't sent us an invoice. We know that we incurred this expense. We know that they're going to send us an invoice after the year end. We would need to record this at the end of the year. So, with the case of a repair expense, we might do debit repair expense, credit accrued liabilities. Let's say it's for $500. Okay, so any type of expense, we go debit the type of expense it is for the amount that it was for. We do not include tax. And then we do credit accrued liabilities or credit accrued expenses for that same amount. Okay, and if we are expecting invoices to be received after the year end, then once we get the invoice, we will record the actual expense and reverse the accrual. So another type of expense that needs to be accrued at the end of the period is payroll. So sometimes there are situations where we pay employees after work is performed and after the accounting period end. So that means we've incurred the salary expense, but we actually haven't paid it, but we need to record it. So the adjusting journal entry will just be debit to salaries expense for the amount that has been incurred for that period, and then credit salaries payable for the same amount. So again, it's work performed but not paid yet, as at the end of the year. And then once it's actually paid, we go debit salaries payable for that amount, and then credit cash for that same amount. So once we've recorded all of our adjusting journal entries, we can then prepare the financial statements. So what we would do is we first would run adjusted trial balance, making sure everything is balanced, the accounts look complete, and then we would run the financials. So income statement, balance sheet, statement of owner's equity, cash flow statement. So that sums up adjusting journal entries for period N. Our next video will be on closing entries, so stay tuned for that one. Thank you so much.